What's up, Gould Miners? Today, we welcome Spencer Hilligoss to the show. Spencer is the founder of Madison Investing, a real estate investing club that helps investors like you and me find great investment opportunities in the commercial real estate sector. Over the last 10 years, Spencer has invested in dozens of projects spanning a multitude of real estate asset classes, from multifamily to self-storage, medical, the list goes on and on. And in this episode, we dive deep into Spencer's journey and the lessons that he's learned along the way. Early in the episode, Spencer talks about the 13 years that he spent in tech before eventually making the transition into real estate investing. He learned a ton of lessons along this journey. He shares some of those lessons with us and also used these lessons as a catalyst for creating his real estate investing club. Later on in the episode, we discuss the fast-paced rise of alternative investments and the incredible rate that the private market sector is expected to grow at over the next 5 years. We also spend some time discussing why so many investors are choosing alts and privates and the benefits associated with investing in this sector as opposed to the public sector. And finally, we wrap up the episode by discussing recession resiliency when it comes to real estate investing and the rules to operate by if you're looking to identify more recession-resistant or recession-proof investment opportunities. Spencer clearly knows stuff. He's super articulate, incredibly knowledgeable, and you're going to have a great time listening to this one. So without further ado, let's welcome to the program, Spencer Hilligoss.
The Gould Mine podcast.
Spencer, welcome to the Gould Mine.
Oh, awesome to be here, Danny. Thank you so much for having me on.
Yeah, man. No, this is going to be a lot of fun, dude, it is very rare that I have someone from the Bay Area on this podcast. You know, lots of people in tech around here, but not too many people in real estate. What do you think that is? Like, why do you think a lot of people around here just like don't really get into real estate investing?
Oh man, I know we were chatting offline a bit ago about just like being Bay Area based, but this conversation, as a guy who grew up in a real estate household, it's near and dear to my heart. I want to unpack some more baggage than people want to hear, TMI wise, but I spent most of my career, my W-2 career, in tech companies, right? And so I worked for my dad when I was growing up, and he was a residential broker for 30 years. He had me, working open houses as an early teenager. I was cleaning out fridges to prepare properties, and all of that stuff, love it, is what scared me into tech. So, I think that ultimately is, when I look back, I'm very grateful for that. I also learned a lot about, what it means to have an entrepreneurial work ethic by watching my dad. But being here in the Bay now and also spending my full focus professionally managing our investing club and investing in big real estate assets that both you and I appreciate. I scratch my head, I scratch my head a lot and wonder, like, why don't all the brilliant people, folks in my network, former colleagues and folks at tech companies across the board, why aren't they leaning in more heavily to a lot of these big hard assets? Because in the end, I know it's not as flashy and as exciting as like dropping a big chunk of your portfolio, allocating it to crypto, and there's a place for that. But this is something that has worked out incredibly well for our own capital over the course of years. And we wouldn't have an investing club that emerged organically unless people kind of got the light bulb moment eventually. But the vast majority of folks in tech still, they tend to stick to what they know. They tend to stick to the familiar. They stick to S&P, they stick to crypto, they stick to stuff that, and even angel investing, right?
Yeah. Well, it's so interesting, right? Because I kind of like on this subject, I have got so many buddies in tech, inevitably they all kind of go down the rabbit hole of, Robinhood. I've got a Robinhood account, right, where I do most of my trading. Can't let it, don't want any financial advisors because they're too expensive, right? So they all manage their own, portfolio. And then, now the sexy thing is crypto, which is fine. I think that there's a certain point, like you gotta be smart about your allocation and figure out, okay, like how am I going to diversify, but also invest in the things that I know. And I think that's actually the thing that most tech guys don't want to admit is that they don't invest in this stuff because they actually don't get it. Like they don't know anything about it. And so they are hesitant to, they actually know more about crypto, which is hilarious, right? Because most people like think crypto is like some foo-foo money, right? But like they understand it so well, they're like, yeah, of course, crypto, right? Like, and they have no hesitation. But then when it comes to real estate, they're like, yeah, I'm not going to touch that because I have no idea what's going on there. Right. And so I actually think like that's kind of like the unspoken reality, you know?
Well, and it's also not as inherently exciting at first glance, right? You and I know it from, and most people I think know it from maybe that conversation they have at Thanksgiving where Uncle Bob says, "Oh, I lost my shirt investing in that rental property or that development deal."
Right.
That's not a great first impression, right? And
Yeah.
I think in the end, buying a home is not exactly approachable for most people these days. It's very unwieldy. So all these things kind of culminate into like big, slow assets, like things that are you can't track as quickly as pulling up your dashboard for Robinhood or going into your Vanguard account and checking on how's your ETF portfolio doing. Like those are things you can get the real-time price point, but you can't go do some of these. You can't get a valuation on a 200-unit apartment building you've invested in on the fly. You have to go get a broker opinion of value, or you have to sell it, or you have to refi it, all these things. So I think you're right. I think it's prickly feeling for a lot of the wrong reasons. But stepping back, like I look at where I was at early in my journey, just for context for folks, like these days, I walked away from my W-2 gig and career, my leadership career, back in 2019. And that was terrifying, right? I mean, we had been building our own passive investments as LPs for years. I've invested over 7 figures of my own capital now into passive investments. But by the time that I pulled the trigger on that, and Jennifer, who's my co-founder in our investing club, and my wife, she and I have both been deploying our capital. And I quit my job in 2019. She quit her career in 2021, and we lead this investing club full time and invest as LPs alongside our investors. But if I had gone back and like told myself when I was, celebrating maxing out my 401k and making great W-2 income from a dual income household here in the Bay Area, I would have been like, oh, that sounds really investing, what, 50K, 100K, 200K on a single check into a big fund for a bunch of hard assets. I'd be like, first and foremost, I don't know what that means. Secondly, I don't know anyone really else that does that. So that sounds scary, and I get it. I get why it's intimidating for folks. But at the same time, you got to go off the beaten track in order to if you want to get different results, you have to do different things. You have to have the courage and bite the bullet eventually to go embark on different paths. And I'm just so grateful that I got 5 companies into my tech career. I worked in mostly fintech. I worked in like Intuit. Most people know that name at least. Yep. They do a third of the country's tax returns and stuff. I worked at a bunch of competitors for them, but the 5th company I was at was a real estate tech company. And a mentor of mine nudged me in there. It's a biggest fix and flip lender in the country at the time. They used to be Lending Home, now they're Kiavi, and they're still out there crushing it. And I didn't know what the heck it meant to really truly go invest in real estate the way that I do now. But like I was surrounded by it. I was immersed in it because I had to learn that business and to get in the guts of what it means to do 600 fix and flip loans per month. And I'm not a flipper, and that's not what we do now, but I had to learn the business of real estate investing from that lens. And that's where I got the bug. And once I got it, I was like, okay, I see the number of zeros, right? I see the number of zeros people are making behind the scenes. And I'm like, if they can do it, why can't we do it? Why can't we figure out a strategy that makes sense for us so we could start, carving a different path? Because I was grinding out 80 hours a week in a tech company for, 13 years, and I wasn't seeing our growing family and our young kids often enough. So something had to give. And now, entrepreneurship and investing is clear as mud when you're going through it. In hindsight, it seems really clear how we got here, but it's taking a lot of learnings along the way, and not just reading books, not just listening to wonderful podcasts such as yours. Like it takes, getting out there and putting some money at work and doing the work.
Yeah. No, I can definitely relate to a lot of what you just said. It's interesting, not to switch gears, but just kind of staying on this track. When was the moment? Because the husband wife, 1-2 punch. I've seen that a couple of times. Sometimes it works, sometimes it doesn't. Right.
Sure.
So what do you think helped the two of you kind of get to a point where you were able to build a successful business together and not have it affect like the marriage or anything like that? Like because I know that like sometimes like it can get, you bring your work home with you, right? But like home is work and work is home.
Right.
It could be pretty, it could be detrimental potentially, right? So how did you circumvent that or navigate through that?
I mean, I appreciate you going there, Danny. I think I'll say right out the gates, it is not for everybody, right? I mean, I think, frankly, I think it's a risky endeavor for most people. To exactly your point, I think it can jeopardize their most important relationship in their life if they go into it without truly thinking about, eyes wide open, what am I doing? Like, what are we embarking on here? So a couple thoughts. So Jennifer and I had already been together for better part of a decade. Married and actually together longer than that, if you include the dating years. And so before we decided to do this, we also in parallel, we'd each had our separate careers, and I was doing, tech operations leadership. Jennifer had a leadership career of her own, marketing, e-commerce leader, absolute badass, but not in tech. She was in CPG companies, in consumer packaged goods companies. And so we had the language of business. And that, I know so many folks, and you've probably seen this plenty of times as well, like folks in entrepreneurship circles, and certainly within real estate, they really love to dig and just rip on the W-2 world, just generally, right? Like they say, oh, you got to quit the rat race. You got to do all this stuff. And like, I get it. I mean, I've literally walked this path, so I get it.
Yep.
But I don't look back at W-2 career as like some hellscape that like it was awful. It was actually deeply meaningful to me and positive, largely. There was moments where it was really hard and challenging, of course, but the relationships built, the mentors, who coached along the way. I say all that because when Jennifer and I started talking about actually doing something together as a business, we realized that like when all else fails, it's much easier to put on a different mode, a different hat, figuratively, and say, okay, how do we approach this problem from a business lens? And it sounds cold and calculating, but that's kind of how you have to get into it when you're trying to mode shift with the person that you love and you're spending for the rest of your life together with, mother of your children. And you're sitting there going like, okay, together as a household with our kids, we want to be in that place in 10 years from now, 15 years from now. That's a personal conversation. The toolkit to get us there is one of business. So how do we actually get there via investing, via entrepreneurship? So we sat down, man, one fateful weekend. This is back in 2016. And we cleared the calendar. We hired a babysitter. We got, it looked like the inside of a couple rooms in tech companies I've been at, where like we had sticky notes, colorful all over the wall. And we sat down and said, we're not going to walk out of this planning session together without understanding very specifically what is the dollar amount per month passively that we need coming in to cover our basic life needs, and some people might have heard like the FIRE movement, financially independent, retire early, and the many, many versions and offshoots of that. We just wanted to know by what year that we both agreed that we could have a certain dollar amount coming in. And that exercise was brutally challenging. Like there was tears, there was laughter, there was reconciliation, and then multiply that out by 6-7 times in one weekend, and you've got that weekend. It was really hard. But walking out of that, we felt as this degree of like alignment on the path forward that I don't think we'd ever experienced. Like we're pretty direct. Both of us are pretty direct as humans. But I think that was a new like breakthrough for us. And so ever since then, I think that really helps cement how we plan and get down to brass tacks. Like you can work through anything together as long as you're both agreed on what your North Star is.
Yeah. But it's interesting that you're sharing that, because I mean, I think that if you don't have that alignment and if you don't take the time to plan and like kind of go through all of that, I think that's where a lot of people get caught up or actually like kind of like lose their footing, if you will, is they don't take the time to like just stop and plan together and then get into, like you said, right, alignment. If there's refusal from one party or another to kind of like, sit down and kind of like hash that out and get realigned, I think that's where issues kind of come up, right? So it's interesting that you go there. I can speak from,
Can I add one more thing to that?
Please.
I think that the one thing I experienced, and these are bumps in the road, right? Like, cause like, I'm not going to sit here and say like, oh, we had that one meeting and everything was smooth forever after this. Like we get in arguments, like healthy couples do that.
Yeah.
But the real challenge early on when I was, deep into career, Jennifer deep into career, and also just trying to show up as good parents at the same time and wear all those hats that we do. Typically, if someone has a new idea for a business or an entrepreneurship, or if let's say get really fired up, like I'll get very excited about investing in a new deal. And I'm like, yeah, I got to show you this thing. Check this out. Look at this email, watch this webinar. Like, oh, we should go invest, 50 grand in this or something. And the problem early on, and this hits everybody, is, I was so way too far ahead on those moments. I was way too far ahead of her on like, I've already gone deep nerding out on this stuff, way down the rabbit hole, reading the materials. Like I had read, 24 books in an 18-month period when I really got the bug on this stuff. And this is dry material. This is like investing, finance, more advanced real estate stuff. And I a couple times, I appropriately so got some pretty stern feedback from Jennifer, because it would be like, she's like, I wasn't on that webinar you were on. I didn't read that book that you read. So right. I think calibrating, if you want to call it that, like I realized, okay, I'll occasionally share in the early days, like I had to slow my roll, and let us calibrate on like where she at, where I at, because I'd rather take that time, even if it's slower sometimes in the early days where it's like, hey, I really want her to read this book or listen to this podcast. And then I want us to be able to hash out this particular topic, because it's worth waiting, because in the end, our partnership as a couple, both as husband and wife and as business partners and founders, is a legitimate strategic advantage. We talk about it that way. Like it's a very strong strategic advantage, because people just don't realize, like when you're all holistically aligned like that, you can make big decisions about everything all at once and then just go. And that's pretty cool.
Yeah, I love that. And I think, getting in alignment, like you said, I think is huge, and that definitely helps. And if you take that time though, and that just doesn't apply to, relationships, that also applies to like business partnerships too, right? So like, or people that you're in business with as well. It doesn't necessarily have to be a husband or wife or spouse.
Totally.
It could also just be like, yeah, my COO and I, like we need to sit down, because if we don't have those constant check-ins and continually reevaluate and realign, then yeah, there's going to be a lot of issues that come up. So I don't think that it's necessarily just you're confined to like that advice is confined to a spousal relationship. So appreciate you sharing that, man. And I could take this a bunch of different ways, because I want to get into the tactics. I want to learn more about like what you guys are investing in. But at the same time, I also you've mentioned the investing club a couple of times. What is that, and when did that start, and how does it support the the actual like acquisition side of the business as well? So like walk me through that.
Yeah. So Madison Investing is our club. It's very simple. I mean, we started this just for our own capital initially. We were looking for great deals. We went through kind of 3 phases of, this is in hindsight, over the course of years, starting in around 2016, phase 1, we bought a local rental because we couldn't get comfortable buying something unseen. So we, overspent, bought a $430,000 duplex in the Bay Area, make $200 a month in cash flow on that. And that is not a cash flow win. It's gone up in value a lot. So we're happy about that, but, then we got the courage to go and buy stuff and invest in stuff that's out of state, long distance investing. But we got up to a portfolio of 5 single family homes in the Midwest. Those were much better economics, but long distance investing, we got on average like $60,000 purchase price average, which is mind blowing for you and I sitting in the Bay Area. And that was $250 a month on average for monthly cash flow, which is killer, So we went through that phase, but then we realized it's a massive pain in the ass to have to, even with a property manager, manage these things. Like you have turnover every year. You have a couch that randomly shows up on the lawn for one of the properties. And as a result, the county is sending you a letter about that, even though it should go to the, just random stuff. And we're like, at this phase of life, overhead is at a premium. So we're trying to keep available flexibility, right? Time.
Yep.
So we eventually started investing as LPs, as limited partners, passive investors in bigger deals. And that's how this started. I mean, it really was that. So we started investing 25K, 50K, sometimes up to 100K more into multifamily apartments and self-storage facilities, because those were two asset classes I became very confident and competent in. Like, I would like start flying out to look at these assets in other places in the Sun Belt, in Texas, Georgia, Florida, et cetera. And once that happened, I was still working full time. I had coworkers that would say, "We want to see what you're investing in, man. It sounds like it's going really well."
Yeah.
And that was the genesis of like, oh, there's probably something here that it's a problem we can help solve while also investing our own money alongside folks. And so that is what this is. Like we go out, we find great sponsors, operators of properties with great track records. They operate multifamily apartments, self-storage facilities, sometimes even like industrial, other assets like that, commercial, big properties that are big and boring in the best way possible if you do it right. And once we get to know them, invest in them, we vet them. I walk around their assets and put them through rigorous due diligence, and folks can invest alongside us in these assets. And that's what we do. That's our investing club. So we've done that dozens and dozens of times now over the course of years. Never planned on being a business from the beginning, but now we have hundreds of active investors that invest alongside us in these things that generate cash flow and growth and all those things that I know you appreciate as well as an investor.
Yeah, absolutely. And so now I'm curious, right? The way that the club is structured, I imagine that there are two ways that you could structure this to where it makes sense for you and for your wife. So the first one would be, it's like a monthly fee to be involved in the club, or the second is that you structured it more of like a fund of funds, right? Where you're investing in these different deals. Like I'm assuming you're putting together like an SPV or something, and you're investing into these deals, or how does that work exactly?
Yeah, we don't charge a fee to be a member. The one thing from the very beginning that I did require is like I speak to every single person that joins. Not just because it's required for certain deal types, because we'll share what's called 506B and 506C deals. Those are SEC exemptions, just for folks who are not as nerdy out on this stuff as you and I. And so there's two ways we'll usually do that. I mean, I'll just join folks in the GP team because I am more actively involved on those deals when we do them. So we find it. We just finished one of these. It was like a great multifamily apartment in the Midwest. I've worked with these same business partners of ours for years, and we all go in and buy this apartment building together. So I'm just part of the general partnership team.
Okay. So you're a GP. The investing club is basically a vehicle, so to speak, or like a channel that you bring investors through. Maybe the other GPs have their own investors that they bring into the table, but like your contribution is like, hey, I'm not only like managing the asset, I'm also I have these investors that are part of my ecosystem.
Exactly right.
Yep.
Yeah. And so on single assets, we'll typically do that. On funds and ongoing other just assets and funds that we like, we will do SPVs. Example right now, we are doing an SPV for a fund that we really like. It's a private credit fund, because that's not going to go away anytime soon in terms of need in the market.
Love that.
Yes. So we're investing in private credit heavily right now, and we put together a little feeder fund, which is not so little and it's growing, and folks seem to like it a lot along with us. So those are the two ways that we share opportunities to our group.
That's awesome, man. That's awesome. Yeah. So that's it's so funny because I feel like that particular model has grown pretty tremendously, like over the last couple of years.
Yes, it has.
Usually, like before, it was like, the operators were just kind of like, they were doing everything, right? They had their own, they were raising the capital and they were doing all these different things, and managing the asset acquisitions, dispositions, all that good stuff. And then it seems like capital raising, because it's so labor intensive, right? People don't understand, like, this is like a full-time, this is like a could become a multi employee business, just in and of itself. Right. And so, and there are certain people that are just better at it. And so they know how to communicate to the investors in a way that like a lot of the operators can't, right? Because the operators are
Absolutely.
more on, they're operators. They're not necessarily like salespeople, right? And ultimately, whether we want to admit it or not, raising capital does involve some sales skills, right? Like you got to be like halfway decent at selling. But I do see, you're a good marketer, man. At like Investing Club, that's a very great, like that's a phenomenal way of kind of like encapsulating what you guys do, because it really is, right? It's a club, get a membership, get access to all these deals. You probably have like some masterminds or webinars or meetings or huddles, or how does that work? Like, what does the ecosystem look like outside of just like an email drip where, they get fed these deals once they meet with you? I'm assuming there's other things involved in the club as well.
Yeah. I mean, in the end, I think it's a very noisy space, right? And I think that what I mean by that is like when I started investing as an LP, there was so many investment summaries, so many PDFs that look incredible. He could find thousands, particularly back in like 2016, 2017, right? And it was like, wow, look at all these amazing deals. And in the end, folks just want to have stuff distilled down in a clear, concise way that but they could still investigate down to a lot of detail, with a lot of analysis. And so in the end, like it comes down to like, we're not trying to do what a lot of tech companies have done. Like VC funded tech companies, they want to scale to the moon, apply tons of pressure for growth, 10x everything, et cetera. That is quite opposite of what we've tried to do here. It is one relationship at a time, literally getting to know every single person that joins. And when it comes to deal by deal and newsletter by newsletter, just try to pack them full of actual education that's useful for people. And that means that like when folks join, it's like usually our primary source of new members is by referrals from current members. So that's awesome. That means we're doing something right.
That's awesome.
And and that means that when a new opportunity comes out, I just tell folks like, don't look at it like it's something that you could invest in. Look at it like we have folks that took a year or even 2 years in some rarer cases where they want to take a long time to say, I want to understand how this works by going through that hour-long webinar you guys put together, by looking through the notes you did, by putting all the education materials together. And it is like a one opportunity, one newsletter time education journey. And like, I'll educate folks with like Loom, Zoom call, it takes a village.
Yeah.
Education wise and format wise. And so we've done, in-person meetups before, but we really find it's just easier for everyone involved to do the ASIC stuff and just, provide education virtually.
Yeah. Yeah. I know. Now, since COVID happened, the in-person stuff is great. I feel like what's really, what has come back with force is, if you do if it's more than just like an hour or too long meetup, meetup, those seem to like not be very like well attended, or feel like, oh, that could have been a Zoom meeting. But I think the ones that really do, like the conferences, right? If they're done correctly, if you can put a full-fledged 2-3 day thing, people eat that up, especially in the space, right? I think that a lot of people do gravitate towards those kinds of things. But you can build that community, you can build the excitement for a lot of those events through Zoom and like online stuff. So totally. It's interesting, man. That's really really cool. And especially here in the Bay Area, there's, to me, there seems to be like a ton of opportunity, just in the education space, just from getting these people familiar or acclimated with what it means to invest as a passive LP into larger commercial deals. I think a lot of people just don't even understand, even with all of the information out there, with all the YouTube stuff and the Instagram and the TikToks and LinkedIn, right? I still think that there is a massive knowledge gap between people like me and you who have studied this, who understand, who do this on a daily basis, and then people who, all they do is, they work their 9 to 5, they have the family, they have, their index funds and some crypto and all that stuff. So I think that there is a certain amount of knowledge that has yet to be, transferred to these people. And so I think like Madison, that's where that comes in.
Yeah, it's a huge part of what people say that they've appreciated about it. It's just understanding the basics, but also there's something about like, if you and I want to go buy, like if we want to sign up for a SaaS product, subscription service or something, we can go online, we can look up some comparative reviews, and we can just make that purchasing decision, right? What's fundamentally different, in my opinion, is once you get over, there's two things about this space that make it very human, in the sense that we all know ChatGPT is awesome, as is every other, Claude and every other AI that's popping up out there. And they're really, really helpful for certain things. Like recently I was going through some fun new testing with like actually having a conversation with ChatGPT on my phone, right? The stuff is incredible. But what's not going to change, in my humble opinion, anytime soon, is that we're talking about very large dollar amounts for the average human to be investing into something, right? Like if I'm putting a check for $100,000, I'm not going to necessarily sit there and say, okay, cool, thanks ChatGPT. I appreciate you preparing me with all the knowledge that I need to go cut this check to a total stranger for $100,000, right?
Yeah.
The human conversation of like truly knowing that you're working with someone who is walking the same path as you, they're taking that risk, that capital risk, and also they've taken the time to go vet human to human. That matters. And it appears to matter actually in some ways even more now than ever, because of the fact we can all self-serve on so much of the cookie cutter knowledge that's more readily available. So I just wanted to share that. I think that you're right on the education front. Absolutely. It's a key part as to why I think folks are playing more in this space of private deals and private funds, and why I like it so much, for all those wonderful benefits. But we can't just, robots won't solve this imminently.
Yeah, no, you could say that again. Well, it's interesting. I had a gal on, Shifra from Preqin, and they're like the number one data conglomerate for alternatives, alternative investments, and private markets are forecasted to like double. Private investments, the private markets like forecasted to like double. I think over, I don't know what the time frame is, but it's a very short time frame. It's like a 5-year time frame or something like that. And I was just watching CNBC. Literally, it was like the day before I was interviewing her. The guy on CNBC was the same thing, right? Like alts, private markets, like these are things that a lot of people are shifting towards, and I think that like I don't know, maybe after COVID, COVID was like a thing where I think a lot of people started to lose trust in the system for one reason or another, and not to get political here or anything, right? Because you mentioned COVID and people go, have a certain, feel a certain way about it, but I actually like if I look back and I just do an audit of like the last 10 years and really start to think about like when things started to shift, I think that has a big role in it. How would you what would you say about that? And have you experienced kind of like conversations that have or what kind of conversations have you experienced kind of like seeing the people's mindset or shifting mindset? Thinking, okay, private deals, private markets might be somewhere I want to put a little bit more attention and money into.
Yeah, and you mean like just like more broadly, like since kind of like COVID era?
Well, yeah, maybe, yeah, since COVID era, or maybe people have told you otherwise, right? But like my intuition tells me that a lot of people started to think this way after COVID.
Yeah, I mean, I think what I'm kind of hearing you say too is like embracing of like contrarian values. Not to get too heady, but I'm always game for that.
Yeah.
Yep. I think that's accurate. I also think that because more information is readily available, like if you look at this private market space, right? And I appreciate you kind of referencing that Preqin conversation you had, and like the forecast for the private market space is it's going to get bigger and bigger. Like all this, the current exemptions and all this stuff that enables us to go invest in these private funds, to partner and invest in an amazing looking apartment building asset in the Midwest, like we just closed on recently. Like a lot of these SEC exemptions in the current form didn't really take shape until around like 2012 or so. I think that was around the year that the Jobs Act was passed, and like that isn't that long ago in the big picture. I know it was over, it was 12 years ago, but look at that to now. And if there's a wonderful chart, I wish I could remember the source data for it, but it was not that long ago, showing the sheer dollar amount, like the billions of dollars that were getting invested in just 506C deals, folks are feeling, based on those numbers, folks are very much feeling more bullish on the private market. Of course, it's helped. There's been some really killer growth years, mixed in for the last, particularly up till 2019, and then COVID took a breath, and then asset values really spiked in 2021. Now we're taking another big old breath right now in terms of asset values, but we're warming up for something that could be very special. And so I just think that folks are looking for more readily available education to play in this space, and it's actually there now. So like there's more education available, not just human to human, which I obviously am a fan of, but also you can self-serve on a lot of the basic stuff, but they still want to make sure that they can participate in a way that's de-risked in some way. I want to give a shout out, which probably seems counterintuitive, but I want to give a shout out to like crowdfunding platforms. I think crowdfunding platforms have actually been a great example of a rising tide raises all ships. They're not perfect. No platform is. But that's a place where most people say, oh, maybe I should go invest passively in real estate. And the first stop they usually get to is, oh, I'll go buy a rental.
Yeah.
Folks who actually bite the bullet on that find out very quickly, unless they want to manage it, it's not exactly passive. And then the next stop for them after that is, oh, let's go check out, those crowdfunding websites. And then maybe they'll do that. And good on them, if they get to that point where they do that, because it's raising the awareness, it's raising the awareness, the education of all how folks can play in the space. And so it's all really been taking off since around that COVID timeline.
Speaking of de-risking, I think that a lot of, especially like the last year, 2 years, it's been rough, right? For a lot of folks in our space, and even for the average American. And I think that in these times, the idea of finding kind of like recession-proof assets or recession-resistant assets or investments. So, Spencer, what have you seen, or what are your thoughts on resiliency when it comes to recessions, and what asset types have you invested in? Because you've been investing for a while now. So, what have you seen perform well, even during this time?
Yes.
And what have you seen not perform well and during this time as well?
Yeah, I think you nailed it, categorizing the past couple of years. So for context for folks, interest rates went up faster in the past, starting in the back half of 2022, the Fed raised interest rates faster in that period of time than they have in the past 40 years. So it's been since the 80s, interest rates went up that quickly. What does that mean is, like, generally when those go up, asset values for commercial real estate goes down. But that's not the whole story. So, I've invested in, just by asset class, like multifamily apartments, large ones, self-storage facilities, mobile home parks, medical offices, obviously a couple single family rentals, duplex, some other private credit, and a couple alternative asset niches, just down the list. And of all of those, I think a key learning that spans all of them is any of those can be truly recession resistant if they're purchased at a good basis. They're purchased at a good price point. Meaning, if you overpay for something, then you're never going to be able to change. You're going to never be able to change that. You can't turn back the clock and buy at a better price. So when people say that real estate platitude of you make money on the buy, that's 100% accurate.
100%.
The second thing would be an incredible asset, like a great apartment building or a self-storage facility. It can be incredible performance, like on the NOI, meaning making great net operating income, good revenue, reasonable expenses, and you operate that thing professionally. If it has variable rate interest debt, if it has floating rate debt, meaning a loan on it, and it's not structured correctly, really all bets are off. And so that is a Achilles heel, and I think that for folks, and this includes some of my investments as well, is like, if I had to pick one that's done, a couple that have done really well, like self-storage has been performing incredibly well in my portfolio throughout the past few years. Apartments apartment deals, multifamily that had been purchased at a great basis, and they've got all the good market tailwinds behind them. Business friendly market. Employment is high in that area, and crime rate is reasonable. All those things, you can go down the list forever on that. And they're on fixed rate debt. Like we're literally exiting a deal right now ahead of pro forma, and this is hard. This is rare. Like in this current context, that we're exiting a deal right now that was purchased in 2020. It was a newer build. And that is the other thing I was going to call out is like right now we're seeing a stronger performance, at least not every case, but most cases on the newer assets, right? And so like the stuff that is built more recently, more recent vintage, if it was built in the 70s and 80s, it's been hit harder. And now I just have to mention this. I know we're coming up against time, but like the forecast for demand is not slowing down anytime soon though, for some of these assets, right? Like multifamily apartments, whatever has happened in the last 2 years, it doesn't change the fact people need places to live and people can't afford to buy homes right now. And that is absolutely only going to get worse. So, all that stuff to say, like the valuations for multifamily is rosy compared to where they are right now in the next 2 to 3 years, because the flip side of high interest rates is that no one kept building new ones. So in the last couple of years, like the starts for new multifamily have dropped off a cliff, and people still need places to live. So we're looking much more bullish in the next couple of years when it comes to multifamily, still leaning heavily into self-storage. And looking forward to hopefully some more favorable interest rates as well.
Yeah, and and I know that we're coming up on time here too. There have been a couple of ground ups that I've looked at recently, ground up multifamily, and to be honest, the last couple of years I've been kind of like talking poorly about multifamily in general. I didn't really. I kind of lost faith in the asset class, not because people don't need a place to live, just because of the cap rate compression. I thought it was just, it was hard to make some of those deals pencil, but there have been some ground ups recently that I think look really, really enticing. And a lot of it has to do with the fact that the prognosis for where we're going to be in 36 months versus where we're at right now. I think everyone kind of sees it. Hopefully the worst is behind us, or kind of, towards or at the bottom. And regardless about how you feel politically, I think that there's a renewed sense of optimism. I think that would have happened regardless of who got nominated, or who got elected. I think that just like having more certainty now, definitely helps, in terms of just getting people off the sideline and into action. So we'll see. I mean, everyone keeps speculating that the rates are going to, it's like, are the rates coming up? Are the rates going down? What's going on with that? But I think regardless, to your point, right? Regardless, like interest rates go up, great. Well, there's going to be way less new construction, right? So that's going to put a damper on things and on construction, and that means that there's a housing shortage, and if it comes down, then we'll have more, prices will go up and there'll be more new builds, right? But there'll still be demand, right? So either way, you're in a good spot. So it's very interesting. Well, Spencer, we are coming up on time, and in traditional Gould Mine fashion, want to make sure that you leave the audience with one final gold nugget before you depart. Take it away.
Find a way to be curious. Find a way to be curious about something. And when it comes to investing and wealth building, it all changed for me when I stopped writing off finance and investing as something that is boring, and and I found a way to get interested. And so if someone can just find a way to get curious about this stuff, I think they'll, over a long enough time horizon and a long tail, they're going to find their wealth picture vastly improving and accelerating if they find a way to get curious about this stuff. So I'll keep it nice and vague right there.
Love it, man. Well, Spencer, you've been a wealth of knowledge. I'm hoping this isn't the last. Dude, you're in the Bay Area. Like we should do we should do an in-person thing. We get together,
let's do it.
Have a longer episode maybe, and really dive into things. But until then, it's been awesome. And all of the information for Madison, the Investing Club, will be in the show notes, and how to get in touch with Spencer if you're interested in learning more. Those will be in the show notes as well. Spencer, been a pleasure.
This has been awesome, Danny. Thank you so much for having me on.
Awesome, man.